Hey everyone, very excited. Michael Kovacs, CEO of Harvest, is back on the channel to talk about a lot of stuff, including the very popular HHIS. How are you, Michael? Thanks so much for coming back.
I'm well, and thank you for having me. Appreciate it. We're always happy to get out and talk about what we're doing.
We got a lot to talk about. You guys have been very, very busy lately, which is really cool. Always love seeing those new stuff coming out of Harvest. So let's get into it right away. I want to start talking. I want to start with HHIC and the new Canadian single
Hmm.
stock cover call ETFs, and then we're going to get into HHIS, of course. And we have a bunch of member questions. Members were able to submit their questions. We're going to go through all of those. And by the way, I'm talking to my audience here. If you're interested in being able to submit a question to the portfolio managers or CEO in this case, when they come on the channel, make sure to hit that little join button, become a member. So let's start with HHIC and the new Canadian single stock covered
Yeah.
call ETFs, which you just launched. So let's just start with the obvious. Why did you guys decide to launch them? And while you're talking, I'll show the screen here of what you launched.
Okay. Well, we've been sort of sitting on our hands waiting to launch the Canadian version, if you will, of these single stock products for some time. We were happy we got approval and are getting it with our first 10 stocks. As you guys know, Shopify is well known.
Mhm.
It's sort of the one that we've been getting the most inquiries on for some time. Um, so that's coming out, some bank stocks, some telecos, um, oil and gas. It's interesting when you look at it, it's almost like that with HHIC, it's almost like a diversified Canadian fund. It's very different from HHIS, which is a little more torquey. You know, you have some crypto and a lot of tech and a lot of technology that's really driving into the future. But with this fund, it's the same idea that we want to have, in this case, initially 10 stocks in HHIC. We're going to equally weight them.
Mhm.
We're going to have that leverage. We're going to write options. We're going to generate a very generous yield and on a monthly basis. So um, we've been waiting to launch it, and now here it comes.
Beautiful. So all 10 of these single stocks will be have the 25% leverage. Same management fee, I believe, as the other ones, right? I just want to get the
Right,
basics out of the way. So
right.
25% leverage management fees, 40 basis points for each. Then you have HHIC, the all-in-one, which is, correct me if I'm wrong, going to have a 0% management fee on top, but it's going to be subject to the underlying. So essentially, people could think of it like 40 basis points for the
Well,
HHIC.
actually, that's where it's different.
Okay,
In,
perfect.
in the case of HHIC, we will
Yeah.
actually own every single stock as opposed to owning the single stock shares.
Oh,
So we,
okay. Okay.
yeah, so we're going to buy each, and it's just really how we're structuring it in Canada. It's actually more efficient. So we're going to buy each one of those stocks, those 10 stocks. We're going to equally weight them. We're going to leverage them. We're going to write the calls on them. And we'll just charge the 40 basis points directly to that fund as opposed to it flowing through from the underlying holdings. So your fee structure, your cost structure is the same. It's just a different strategy in the structuring of the fund.
Okay, yeah, yeah, that was my mistake is when I actually went and looked in HHIC, I saw the 40, the management fee.
Yeah,
Now it makes sense because you're going to hold the underlying stocks rather than the underlying ETFs themselves, unlike
right, right. So
HHIS.
there'll be no fee on fee. There's no layering. It's just a baseline fee on that
Okay,
strategy.
perfect. I always got to ask because it's
Yeah,
a consistent question I always get all the time, right? The fee. So
right.
let's talk about stock selection for HHIC and the Canadian ones that you launch. I noticed
Mhm,
kind of like the leaders in each field, right? You got the two big banks, you got Bell
mhm.
Talus, you got some really big cap oil and gas slash materials, including one that I had to look up myself, Cameco. I don't even know
Yes,
if you pronounce it that way. That's a uranium company.
chemical. Yeah,
Chemical. Tell me about the stock
yeah,
selection.
yeah. Well, as I mentioned earlier, it's a little bit more of a diversified selection than the HHIS. You're looking at the Canadian market. It's a unique market in the sense that there's a lot of resources in our market. There's a lot of big banks. Um, Obviously, we don't have any insurance companies, but insurance companies as well. We're a little more concentrated in the Canadian market. So it's a much more diversified portfolio that way. But you do have a minimum market cap of $20 billion, which is what we have in our HHIS.
Okay.
So we wanted to, first of all, make sure that we're selecting the largest stocks in Canada, reputable stocks, stocks that in many cases trade on US markets as well. so we can access those option markets as well as the Canadian option markets. So we're starting off now with a couple of the large banks, Royal Bank and TD. You mentioned Cameco, that's in there. Agnico Eagle, which is another mining company. CNQ, so you got some oil and gas. Bell, TELUS. You're really getting a combination of a variety of sectors of the largest companies in Canada. And then what I think is going to be the real performance driver will be Shopify. It's just been a fantastic Canadian tech story, and just it has to be in there. It's a leader. It's got a great future in front of it, and we want to own that for sure.
Makes sense. Yeah. And yeah, really the big boys, the big cap
Yeah.
stocks. I know we can't talk about yield. The first distributions haven't been declared. So I think we're limited in what we could discuss. But what I do want to talk about, you said something interesting, access the options market. Some of these stocks are listed in
Yeah.
the American stock market. So
Mhm.
I have received a lot of questions and concerns saying, well, how high could the yield be? Because these stocks are less volatile. Canadian stocks in general are less volatile than, for example, the American ones. And the options market is a bit liquid. So can you talk a little bit about, are you going to be okay writing the options? Is there enough volatility here to get that high income?
Well, it's a great question. And Harvest tests things, and we go back quite a bit when we're putting together our portfolios. We'll have a number, and then we'll go below that number to make sure
Hmm.
that we're going to be able to consistently pay at that yield. The yield may be more generous than people think. You've got some great stocks in there, but when you're writing options on, in some cases, up to 50%, and you've got 25% leverage, you can get your yields up pretty nicely. So, I mean, I'm not talking about 45 or 50% some of these crazy yields, but it should be a pretty generous yield. It might be more than people think. That's all I can say right now, because we're just sort of finalizing it as we
Hmm.
get into the final prospectus. But the number should be pretty good,
Okay, I have my guess. I have my prediction. I did it in a video
right?
recently, so we'll see about that. We'll see what happens. Looking forward to it. But yeah, so just to reiterate the cover call strategy, up to 50% coverage, that's the max, but normally your Harvest is a bit more comfortable at the 33% coverage ratio. Is that still the case?
Yeah, all our modeling is based on 33%.
Okay.
So we can tip it up if we want, but going back to our comfort level and having enough skin in the game to capture upside in the market
Hmm.
if
Hmm.
get a rally.
Okay. So is it fair to say HHIC will only have the Canadian names and HHIS will only have the US names for the two all-in-ones?
Yes.
Okay, okay.
Yeah.
And you started with 10, but I'm assuming maybe you'll come out with ones later, future
Yeah,
Canadian.
I mean the door is open for that. So we want to, I think 10 is a good tranche to start with.
Yeah,
You remember when we started a year ago with the with the US single stocks, we only started with 4.
right.
So we build them out as we go along. It's a good handful of stocks to start with. So we'll start with 10 and we'll add to it as we go along.
Sounds good. Sounds good. Final question. So
Yeah.
HHIS, we know that, you kind of put a cap on 15 names for now. Will HHIC have a cap of 15 as well, or it's open-ended, not decided yet?
It's not decided. We've left that door open. We haven't put the cap on it, so we'll see where that goes.
Sounds good.
So
All
right
right,
now,
perfect.
there's no cap on that.
Okay, pretty clear for the new Canadian ones. They're launching this month, right? In August, sometime in August, I
Yes.
believe.
Yeah.
Okay.
As soon as we get it finalized, we'll get that out, and hopefully that's before the end of the month. I think it
Yeah.
should be.
Yeah, and one thing I want to point out to my audience who's saying, oh, well, it might not have a lot of yield. A lot of these stocks have high dividends themselves. So you're still capturing by holding these stocks, you're still capturing the base layer dividend yields plus the premiums as
Mhm.
well. Typically, the Canadian stock market is more dividend rich, the stocks, than the US stock market, right? Do I have that
Yeah,
correct?
and if you think of some of these stocks, I mean, I think CNQ, the yield on it is over 5% right now,
Yeah.
5.5. So I mean, it's to take that yield higher with some leverage and options. It's not that tough to do.
Yeah, exactly.
Well,
That's
that's what
what
I'm
some
saying. I think
people.
the yield might be higher than people think it might be.
Yeah, that's why I mentioned it. A lot of these stocks do have Enbridge as well, the banks,
Yes.
of course,
Yeah.
TELUS, Bell. They
And
have pretty.
Shopify has got so much volatility, which helps us drive that premium.
All right. Perfect. I think we're good for the Canadians one. Now on to HHIS, the US ones. I've
Right.
received, I've reached out to my members and asked them, what do you want to ask Michael Kovacs? I've never gotten so many questions in my life since I've done this. It's absolutely incredible. So I'm just going to go through the list because they're all good questions. We'll freestyle, maybe
Okay.
some questions I could think of. So the first one is in uppercase, and I think this was the most voted. Tell Mike that we love him. That was the number one comment I got. So,
I appreciate
um,
that.
also, what would he say to anyone who wanted to go all in HHIS? That's a pretty funky question. Go for it.
Yeah, well, that's really a matter of personal preference, right? I mean, when you're buying, well, I mean, when you're buying HHIS, you're buying 15 stocks. You're buying a portfolio of 15 different companies. So if you had a portfolio and you bought 15 stocks, it's equally weighted them. It's the same ideas. So it's really someone's personal preference if they want to take a 100% position of their portfolio in HHIS. I've always been an equity guy personally, so I don't have an issue sort of putting on big bets or taking risk, but it's really up to the individual. But I mean, it's sort of a portfolio that I love. I love the names in that in that product. So it's really just a matter of if you're willing to ride out that volatility, because it will be volatile. We've had a great market and we're still having a great market. Even today, I think the market's up quite a bit. At some point, the market pulls back. And when it pulls back, these things can pull back even faster. So if
Yeah,
you're confident and you like these companies, it could be a buying opportunity. So you just have to take that long-term approach, and I think you'll be fine. 100% position, that's your call, right?
for sure, for sure. Yeah, that's what I keep trying to tell people. You are investing in 15 stocks. You got to look beyond the ticker symbol. So next question, if one of the underlyings out of the 15, I believe, become weaker, can it be switched out? So right now, there's 15 names and all 15 are in HHIS, but I'm assuming, I guess another question is, are more names coming and can some be switched out later on?
Well, great, a good question. First of all, there is only 15 right now, but there will be more stocks coming in the fall. Um,
Okay.
so from that standpoint, yeah, if there's a company that's got a more compelling yield, and we love the long-term upside of it, and it's in the group of different single stocks, we can swap out a name. So we absolutely can. But it's like anything. You want to make sure you've got that compelling upside. You want to make sure that that yield is comparable or higher than the one we're taking out, because we do want to keep that yield level consistent. But it
Okay.
can be done. So to answer the question, yes, it can be done.
Excellent. Okay. And I like the fact that you mentioned there's plans for more coming, which is cool. Okay. So next question, from an insider perspective and the fund now having some history, are the distributions sustainable? Were you close to reducing the distribution? We're talking specifically for HHIS here, the all-in-one.
Yeah, well, first of all, you're right. It's 6 months of history, so it's not a long track record. But at this point, there's been no issues meeting the distribution level. And actually, remember when the fund first came out, I had a little rally, then the market sold off,
Yeah,
and then the fund came down to, I think at one point it got into the 9 range. It came down quite a bit. But again, the distribution was never under duress. We were able to maintain it, and we're quite comfortable with it where it is right now. So we expect that's going to continue to be the case.
awesome. Okay, perfect. The next question is, we already discussed it. It's about that 15 cap. Is HHIS always going to be max 15, or could that be increased, or you're not sure yet?
It's a good question because there's so many unbelievable opportunities. The United States is full of them. Some of the companies, even some of the ones that we're looking at bringing out, are just amazing businesses. Um, so, I mean, we could sort of take the barriers off of it, but we also like the idea of being concentrated into 15 names. So at this point, there's no plans to take it off, but never say never. It could
Right.
change, but this is where we'd like to stay at this point.
Okay. Yeah, the person further question, if there's more and more and more coming out, or would you make, I think the question is, would you make another one that has all of them? So
Probably not. Probably
okay,
not. No. You just start
okay.
getting too many variations of it, and at the end of the day, you want that strong, torquey portfolio that's got that great yield.
Okay, another question by the same person: is Harvest looking to create any zero DTE option products?
It's not on the table right now. Again, you never say never, but it's we've got, as I mentioned, 10 single stocks coming out in the Canadian market. We've got another few coming out in the US market. Our hands are full, so it's not on the table right now. And when you get into a shorter duration products like that, it changes the modeling. It changes your ability to work with the option markets to generate cash flow. It bumps up your costs as well. So there's all these other little variables that build into these types of transactions, these 1 day sort of same day expiries.
Okay.
I mean, you could get great yields, you can get great premiums. Don't get me wrong, but it's 100% hands-on game all the time. It's a
It's
different game.
very labor
Yeah,
intensive for sure. That I've heard that.
yeah.
Um, okay, so next question. I kind of get a variance of this question very often, especially more for newer from newer investors. I'm curious to see how you would answer it. Why the explosive surge in ETF providers and different offerings? Will ETF popularity invite additional risk? So I think the premise behind that question, I'm guessing here, but I'm pretty sure a lot of people have asked me, with all these new cover call ETFs coming out from many different providers, isn't going to be hard getting call premiums? Is there enough liquidity? I think option liquidity is the main concern here. What would you say to that?
Well, it's a great question, and I'm happy to talk about the industry because it's, I guess, to the first point, the reason why so many players have come into it is that this is one of the fastest growing industries on the planet. I mean, you've got a compound rate of return of close to 20% as an industry, which is a very, very fast growing industry. And as we all know, it's really taken off in the last 3 or 4 years. So when you have, it's like the siren call, when you have this sort of growth, everyone starts to pay attention to it, and then people want to step into it and design new products. So I think where the risk is, it's always buyer beware. Just make sure you do your homework and you're comfortable with the manager, the issuer behind the product. Sometimes people get overzealous and they launch all kinds of really interesting ideas. Some are good, some are not so good. And I think that's where your risk is, not so much in the industry itself, but in the types of products being developed and how aggressive they're trying to go at it to raise capital. So with regards to the other part of that question, if I remember, it's when we started doing option writing 10 years ago, no one was in the game. It was very few players.
Yeah.
There was only ourselves and CI and BMO, I think. And it's just become flooded over the last few years. But I look at us as one of the originals. I look at us as a company with the deepest option writing team in Canada, very experienced, tenured team, and feel very comfortable with what we're doing. So we don't feel that we're taking on undue risk to bring out these products, but you really have to look at other issuers and their team, if you will, to make sure you're comfortable with them. Does that answer
Okay.
the question?
Yeah, yeah. I mean, what about like options, liquidity? Do you feel like if
Right.
just the market is getting saturated, for example, with these covered call ETFs, is there going to be enough market liquidity? In the US, I've asked the same question. They said it's just still a fraction. It's still completely
Yeah.
fine. So what are you seeing on your side?
Yeah. Well, first of all, the individual, in the sense of our funds, they would have to get huge. I mean, they would have to be in the 20 billion mark themselves per fund to get to a point where you may have some issues around option liquidity. But it is very fractional. The U.S. markets, the option chains are very deep, very heavily traded, and you can go in some cases years on these things, and there's a market for them. So it's a very different market than what we have in Canada. And this is one of the reasons why we want to make sure that a number of the stocks that we have, we can write options in both Canada and the United States, so that we've got access to those option markets. So whoever mentioned that about sort of being a fraction, I don't know how big the fraction is, but it's still a small part of the overall option chain, if you will, in the US market.
Okay. Sounds good. Next question. Can they add index-based cover call funds with 25% leverage that pay weekly? This person really has some hardcore requests.
Yeah,
If yes, Harvest will be adding to their amazing product line.
yeah.
Love their funds.
Oh, thank you. Um, okay, so we have, again, we've talked about indexes, you know, S&P and NASDAQ,
Mhm.
levering it, and writing options. It's not a complex thing to do for us. It's just, you know, if we're trying to be innovative and come up with different ideas that are unique, that isn't as unique. Even when we started in the ETF business, I remember talking to a lot of individuals and advisors, and they thought ETFs were just indexes. And, you know, they're not at all. You know, one of our first was Harvest Healthcare Leaders. It's it was very unique in the industry. It's grown into one of the largest healthcare ETFs in Canada. But uh, where was I going with this? Um, anyhow, we're very comfortable.
Indexes.
We're very comfortable with what we're doing. Um, we don't feel a need to launch indexes right now, but that could be a case in the future.
Okay. They are the products pretty much exist
There's a
already on
lot of them
both
out
of them.
there already. Yeah.
There's a lot of them. Yeah. What about the so weekly paying are very very popular in the US. In Canada, we only really have monthly and semi-monthly now. So is weekly even possible? Are you thinking of maybe for HHIS, for example, a semi-monthly or
At this
distribution?
point, we're not. Um, Going back, I answered sort of answered that question a little bit before. When you start getting into weekly pays, your costs go up quite a bit, but also your horizon for option writing has to change because now you have to generate that cash flow on a much shorter basis. And when we're looking at writing options, sometimes we write a little bit at the beginning of the month, a little bit more each day, a little bit more into the month.
Hmm.
Sometimes we'll take a position off, we'll add, expand it. So a 30-day window isn't a huge period of time, but it gives you the ability to have a little more flexibility to meet that distribution level. It just changes the game when you shorten the time span to generate that cash flow. So it's enticing, I understand, like weekly getting a check every week, but it's at this point anyhow, it's not in our plans.
Okay, fair enough. The next question is relating again. It was similar to another question about if, there's so much options writing and so much
Mhm.
new funds, will it be negative? But we'll skip that. We already discussed about it. Next question. I've been getting actually this a lot. I don't know if you've been getting a lot of requests. HHIS.U could that
Mhm.
be a possibility? So an HHIS denominated in USD.
Well, it could be a possibility because we are internally getting more and more of those questions, not only from members of your audience, but also from the advisor community. They're asking about US dollar versions. So, you know, we sort of were concerned initially because a lot of US dollar positions we've had have been less than 5% of the total assets. They've been very small. But I actually think this is one that we may have to take another look at this fall because it's, you know, there just seemed to be more and more demand for it, HHIS.U.
Yeah,
So
is this your
it is in the realm. It is in the realm of possibility, if I can sort of couch it that way.
Sounds good.
Yeah.
Sorry to cut you off there. The internet is not exactly 100%. Yeah, HHIS, is it? I mean, I think you're past 730 billion. Is this the fastest growing, most popular ETF you've ever had so far at Harvest?
Yeah, 730 million. I wish it was a billion, but it's 30
Sorry,
million.
a million. Yeah,
That would make it the biggest.
yeah,
Um, it has been the fastest growing out of the gate. I mean, we remember a few years ago we launched a travel fund and it jumped to 200 million pretty quickly. Um, the HPYT jumped to 400 or 500 million pretty quickly, but this is definitely, and then our HL is over 1.5 billion, but that's been a sort of slow growing product. It's been a little bit
yeah.
of a different trajectory, but this has been a very quick launch for this product.
Okay, perfect. Last question. This is more of a confirmation. So HHIS has a zero management fee on top, but it's subject to the underlying other ones, which is 40 basis points.
Right.
This is not a promotional thing that's going to end. Is HHIS always going to have a 0% fee on top and be subject to the underlying?
Yeah, it's locked in. It is zero fee.
Okay.
So the fee is what's generated from the underlying holdings.
Okay.
Yeah.
Perfect. So that's it for the member questions. I think I have maybe a few of my own real quick here,
Right.
but you kind of already touched, you already touched some of them. So maybe we could, sorry if you have to repeat yourself, but let's just say when more of those names come out in the fall, let's say there's another 5 or 10, how will you manage the HHIS? Like, are you going to be doing the swaps right away? Are you going to be waiting? What's the strategy if
Well,
you've
that's
thought
yeah.
about that already?
It's hard. It's hard to answer that question because we have to wait to see what they come out, what the market's doing, what kind of yields they're going to be generating, before we start making those decisions. But if we did a swap, it would probably be over like a 30-day period.
Okay.
So, I mean, the fund's gotten quite big. So if you take out one position, that might be a 50 or $60 million position that has to be swapped over. So we would probably do that over a number of days or weeks to make that change.
And what would make you do that change? Is it yield? For example, let's get Costco out of here because it's a super low yield.
Mhm.
Is it just yield? Is it performance? Is it people requesting it? Like how do you make those decisions?
Well, I think the first thing we look at is the yield.
Okay,
Uh,
so that's a
if
big
you've got
factor.
a new product that showed up that's got a yield of 30%, and other ones in there yielding 9, we would probably move it. We would probably change it. Um, but all of those companies are very, even Costco, they're all market leaders. They're very dynamic. They're innovative. They're growing businesses. It's really hard to take a name out because they're great companies. But we would probably first we'd have to look at the yield, and then we'd look at the actual underlying story behind it.
Fair enough. I tried to put myself in your
Yeah.
shoes to
Yeah.
make the decision, and even I was like, I don't know what do I do? I don't know because
Yeah.
I still
It's
like Costco and
yeah.
Netflix and Google. I still want Google in there,
Mhm.
but maybe I do want something with 30% yield, like
And,
maybe.
well, and that's where you come back to maybe do we take the guardrails off and we open it up to 20 stocks, or do we do something like that? So because there are so many unbelievable companies, and we talk about Costco, but I mean one of my favorites is Palantir, and it's just when I see what that company is doing and how they're expanding, and Alex Kemp was talking about adding 5 companies a month to their roster. I mean, that is a company growing at a blistering pace. I think that stock's got a long way to go from here. So how can you possibly replace that?
It's tough. Yeah.
It's a great company, and
Yeah.
you want to stay, or Strategy Corp, right? Or Coinbase. I mean, they're all great businesses, and I'm glad that we have this product and they're all positioned in there.
Yeah. If my vote would count for anything, I think p putting the guard, taking out the guardrail, maybe going to
Yeah.
20 makes a little bit more sense. But
Mhm.
like you said, we'll have to see how many of them come out. Is another 10, another
Yeah.
5, another 50? I mean, who knows, right? So looking forward to it, for sure. So my final questions are going to be around distributions. So
Hmm.
HHIS has been a consistent 25 cents. No changes there. But if you look at the individual ones, some of them have gone up because of great performance, like
Hmm.
Broadcom and Netflix and AMD. Some of them have reduced a little bit, like the Tesla one at one point. Even MicroStrategy, it went 60 cents and it went to 66, back to 60. So
Hmm.
for people who are a bit newer, obviously we know that these distributions are based on volatility, net asset value. So what would make you increase one or decrease one? Tell me the thought process that goes into determining these distributions.
At the end of the day, it really comes down to the volatility. I mean, you mentioned MicroStrategy, and it seemed odd. I saw some comments. It seemed odd that why is the dividend dropping back down that month? It's because the volatility dropped. The stock got higher and higher and higher, and the volatility level actually reduced.
Yeah.
So even though the stock was up and the company's doing well, the amount of volatility reduced, and that cut the amount of income we could generate on that portfolio. So it went back to the original 60 cents payout. So it really comes down to the volatility level, and as to predict what kind of income we can generate.
Yeah, it makes sense.
And
So
going back
that's
to that earlier question, somebody asked about, can you do weekly? Well, this is all the stuff that sort of combines into doing a weekly pay, because you're really shortening your horizon, um, for especially around the option strategy to
yeah.
generate cash
Ma-
flow.
Yeah, makes sense. Going back to strategy, I was actually I even predicted it would be less than 60 cents because I saw volatility go off a cliff, which
Mhm.
is something Michael Saylor even predicted. As Bitcoin gets more and more adopted, volatility is going down, 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 and I just saw it
Mhm.
go down a cliff. I'm like, wow, I don't know how they're gonna do 60.
Mhm.
So, um, yeah, I mean, it's I guess it's that balance between the net asset value going up and up, which it has been with
Mhm.
the volatility. So here's maybe one question I could: would you rather reduce the distribution a little bit and stay at 33% coverage, or would you want to sustain that distribution and increase it to maybe 40, 45, maybe 50% coverage? What would be your preference at Harvest?
I think for the most part, we'd rather stay around 33, but to go to 36 or 38 on a particular month because things have moved a little bit, uh, that's easy enough for us to do. But when you start moving to 40 or 50, then you're going to have to try to maintain that higher level for a longer period of time. It's almost there as an emergency, you know, release valve. If we get to a period at the end of the month and we want to write a little bit more to generate that cash flow, we'll do it. But the more we can stay closer to 33%, the better.
That makes perfect sense.
And maybe it's just I'm a little maybe old school, but I'd rather see that nav get more strength too, as
Yeah,
opposed to writing it away.
no,
I'd
I'm with you
rather see
because
navs get up there.
people sometimes get frustrated, but you know that the more you write, the more upside you're giving up. So it's always
Mhm.
about that trade-off. I personally, I think personally, I would rather stick to the 33, capture a big up move if there is, especially for something like strategy or Tesla, which could go up like crazy and then go down like crazy, than write more just to sustain. And so that's my personal
Yep.
preference, is because a lot of new investors, they see a decrease and they think it's something bad with the fund, or these are not dividends. I remind people, these are not dividend
Yeah.
stocks, it's called premiums.
Yeah. No, if they see a bump down of a few pennies one month, they shouldn't get worried that there's something wrong with it. It's just the volatility level has declined for whatever reason at that point.
Makes sense, makes sense. So thanks so much. We talked
Welcome.
a lot about HHIS, HHIC, the new ones, the single stock ones, and I know that you will be back very, very, very soon to talk about something that Harvest specializes in, the healthcare sector. So we're going to
Mhm.
talk a little bit about HHL, the recent decline with the healthcare stocks. Is that concerning? And I've been getting a lot of questions about HPYT as well. There was
Mhm.
a distribution reduction. We'll talk about that as well. So yeah, we'll talk soon.
Okay. Thank you.